appreciate having you here. And I think this will be a really good learning experience for you, and maybe even a little bit entertaining, and definitely giving you some things that you may want to talk about if you're celebrating Thanksgiving. Just a couple reminders on this. I will have questions at the end. This goes for about 70 minutes. I will be recording this, so this is being recorded, and I do plan on sending the recording and the slides afterwards. So just a little bit about myself before we get started. You can see my titles here. I'm a professor of practice at University of Wisconsin-Milwaukee, and I also help out IE Business School as an adjunct professor. My background, where I got a lot of interest in macro and economics, I started as an analyst, following industries, and as a portfolio manager, I was at a very large pension plan. And then but I got to a leadership role, and in that leadership role, I had to kind of think about all the different industries and what's happening in the world, and that really got me involved in macro. Just thinking about how the economy impacts asset classes in different sectors, and I've just learned how very important this is. Although my career started, looking at balance sheets and income statements and talking with management, all are important. Government policy, fiscal and monetary policy can have really meaningful impacts, and that's really what I wanted to talk with you about today. So three things really are in the presentation. One is federal government policy or fiscal policy, Federal Reserve policy, monetary policy, and let's compare a little bit fiscal versus monetary policy. We'll look at what some Fed policy rules say, and we'll also include at the end on whether the Fed should pay attention to bubbles that form in the markets. And some people are saying there's one forming in the market right now. So this should be a good discussion. We'll start with federal government policy. So we're going to talk about basically the federal deficit, which has been growing, outlays and receipts. So where we get the money and where we spend the money. We'll talk about deficits, debt, and the economy, and this debt limit. So first thing to know is the government budget is cyclical. When I say cyclical, it means it cycles with the economy. So the graph on the bottom here, the green is just GDP growth over time, and the black is just the deficit, basically how much more our spending is than our tax revenues. And you can see they kind of move up and down together, with the deficits going really far down in a recession here, and this was a recession here. Now, the reason why that happens, and we'll talk a little bit more about this in a later slide, is during recessions, the shaded areas are recessions, the outlays or spending tends to rise, where your receipts, your tax revenue tends to go down a little. Fewer people have a job, so they're not paying as much. And then the reason why this goes up is a bunch of automatic spending happens in a recession. We'll get to it a little bit later. Now, when we're talking about the government spending total, the government consumption spending as a percent of the overall GDP is about 17%. It's not nearly as big as the consumer, but it's still a pretty meaningful percent. Looking at these other percents, investment spending, net imports, well, in the consumer, using the same green shaded, that's GDP growth, you can see the consumer is the blue. It tends to move pretty much right with GDP. Trade, on the other hand, it moves in kind of a little bit of an exaggerated fashion to GDP. And the trade and net imports, because we have more imports than exports, it tends to go up a lot in good economies and down in bad economies. And you can see the scale here relative to the GDP. So net imports is very volatile. And the next webinar I have, we'll actually be talking about trade. And then we also have investment spending. Investment spending is also extremely volatile relative to GDP, which is again on the left scale. So you have different components of the economy. Consumer kind of runs with the economy. Net imports runs kind of in exaggerated fashion, and so with investment spending. But the government deficit kind of runs also very much impacted by the economy, but spending goes up. So it's kind of counter-cyclical, and it's really the tax revenues that go down. Okay, so outlays. We all know that our government is in the United States is, the debt's rising. So outlays is rising, and it's actually also rising as a percent of GDP. So it's not just that our outlays are rising, it's just that it's getting a bigger proportion. So if you look at the total outlays, we're nearing a quarter of the economy is just based on government spending, and it's up from around 17%, a little over 20 years ago. We also every once in a while argue about this debt limit, which is now $41 trillion. The current debt, the latest government data we have, is just under 38 trillion. And you can, see it's really been accelerating here, the amount of debt over time. Now, a lot of people may ask, what does the OBBB, the one big beautiful bill, due to this amount of debt and the deficit over time? So the black line in here, this by the way comes from the Congressional Budget Office data. It came from a website of a bipartisan policy. So I was trying to get kind of a neutral assessment of what this new bill or law how it impact the budget. So first of all, the blue up here, that's spending increases. So you can see that the spending increases are pretty much positive in earlier years, and the spending cuts down here are not as negative in the earlier years. So the initial impact of this bill is positive on GDP overall. It's very negative on the budget deficit. So that's what the black line is here. Cumulative total to 2034, the various estimates is the total amount of government debt will increase 3 trillion from the baseline that was expected before that, all right, which was not really a good situation. Now, 3 trillion, that's on 38 trillion. So you can see this new bill or law will basically impact the deficit by about 8%. So 8% worse than it was initially. Now, when we say 38 trillion, that's a big number. So what does that really mean to you and me, right? Well, you can also look at this. You can go to this website. $38 trillion in national debt is $111,000 per citizen of the United States, or per taxpayer, $328,220. So if you didn't eat, you didn't breathe, you didn't live in a home or anything, and you just collected your income until you had $328,220, and everybody else that pays tax in the United States does this, then however much time it would take to get that for each person would be how much time it basically would take to pay off this debt. When you say it like that, $328,220 a person, it becomes a little bit more real. We'll look at how this compares to other countries a little bit later, but the sad part of it is that our situation, our debt as a proportion of GDP is rising, and it's getting worse relative to other countries. Now, we have this deficit right now where we have more spending than we have in tax revenues. The thing that's a little alarming to me is that our current unemployment rate, well, we got a new unemployment rate today, but the unemployment rate before today, by the way, today is 4.4%, but the unemployment rate before today was 4.3%. 4.3% unemployment rate is relatively low. So that basically means you have a pretty good economy. Typically, when you have a pretty good economy, so when unemployment rate goes down low, what happens to this deficit? It becomes less. What is our current deficit? 5.8%. That's one of the worst it's been at this low of an unemployment rate. And you can see on the graph on the left, the deficit, which is as a percent of GDP, is in the blue. It's been getting bigger over time. Okay, and it kind of runs opposite of unemployment. So when unemployment rate, which is black, goes up, the deficit goes down. Why is that the case? Because, well, when unemployment rate goes up, you have lower taxes. Okay, so that's an automatic stabilizer. When I say that is lower taxes, that means people are paying less taxes, so they should have more money to spend, unless, of course, they're unemployed. So the reason why spending goes up in a recession, when unemployment rate goes up, you got more unemployment insurance, you got food stamps, you got Medicaid. So the deficit, outlays minus receipts or spending minus taxes, as a percent of the GDP is very much, when unemployment goes up, so the economy is going down, the deficit, or the amount of our overspending relative to taxes, gets bigger. This is not a good situation. What makes me worried about this situation, if our deficit is running this high or this negative during what's a relatively good time for unemployment rate, what happens if we have a recession? Can the government afford a super large deficit again if the amount of debt relative to GDP is relatively high? I kind of think about Fed policy and the federal government policy, fiscal policy is, basically a little piggy bank. You sock some money away during good times. During good times, when unemployment's low, back here we ran a surplus. So basically, back here at surplus, our spending was less than our taxes, so we basically can make the piggy bank bigger, so when the rainy day comes, we can spend. But if we're already spending way more than our taxes, will we have that ability, and if our debt amount relative to GDP is large, will we have ability to spend a whole bunch when times are bad? That's kind of my concern with the deficit situation as it stays today. All right. So, the piggy bank example, you could also say, well, the federal government is kind of like the good battery that will jumpstart the bad battery when the bad battery is dead in the winter or in the recession. So we can, the point I'm actually trying to make here, if our spending, which is outlays as a percent of receipts, is rising and our tax revenues are not rising, so this gap is growing, which you can actually see. This is just another way of looking at the deficit, which I have in blue here. If this is wide right now, how can we make it really wide in a recession in order to have the government spend a whole bunch of money and be able to afford reduced taxes in that situation? I'm a little concerned. The nice thing, though, we got the federal government, but we also have the state governments. And looking at their deficit as a percent of GDP, state and local deficit, it was getting worse, but it actually ran a surplus during the COVID periods of time. And it's now relatively low. Now, state and localities are supposed to balance their budget, so this being negative is not necessarily a good thing, but it's not nearly as alarming as what's happening over here with the federal government. So how do we spend our money and how do we collect our money? So this is using the latest data we have on this, which was end of September. On the left is how we collect our money. So in the United States, most of the tax revenues we collect, 51%, is from individual taxes. And then social insurance and retirement, Social Security and what we pay in payroll taxes, that's another 36%. So basically the individual is contributing about 87% of our tax revenue. Now we often talk about corporate tax rates, but the fact of the matter is it's only 9% of the total taxes collected in the United States. Custom duties, well, that's the tariffs, is 4%. Or 3.7% in September, up from 1.6%. He says, okay, that's great that we're having more tariffs actually paid part of our, taxes. And so you say, well, that's a good thing, but it's still only 3.7%. This corporate taxes as a percent of our total taxes is the gray line down here. You can see back here in 2007, we were collecting about 15% of our taxes from corporate taxes. And over time, it's come down. Now, here, this is, cutting taxes with our first tax cut back in 2017 or so. This was a recession. Of course, corporations make less money in recessions, so they're going to pay less taxes. This is also recession, but generally what you see is the amount collected from corporate taxes has been going down. And this, light blue line, that's right there, that's the custom duties that's going up. But again, it's a pretty small amount. Now, what do we, this is where we get our money. What do we spend our money on? So you say, well, if our deficit's big, the way you can solve it, you can increase your taxes. When you increase your taxes, politicians may not want to do that because they could lose their job in the next election because people generally don't like, increasing taxes. The other thing you could do is reduce your expenses. So where do we spend money on? Well, Social Security. So for the retired folks, this is 23%. And Medicare for them is 14%. So now we're up to 37%. Now this health, Medicare is health, but this is also Medicaid and the CDC and various other things. That's another 14%. So can we really get rid of that? So we're up to 37 plus 14. That's 51%. It's pretty hard to cut these because, again, if you cut these things, you may lose election. Okay, well, can we cut net interest or interest on our debt? Well, if we do that, that basically means we're defaulting on our debt, and that could actually raise interest rates. That makes our deficit situation even worse. I probably don't want to do that. So that 65% here, you really don't want to, touch. Or if you do touch, it has pretty dire outcomes either for our interest costs on our debt because we default, or elections for politicians. Can you cut national defense? Well, that's another 13%. So what I was at 51% here, so 37, actually that's 51. This is 65. Generally, people don't like cutting this, especially Republicans. So that's 78% of our budget that we can't really cut. Should we cut income security, which gets you up to 88%? Well, income security are things like unemployment compensation. So, these people lose their job, just don't give them anything. I probably don't want to do that either. So this 88%, you don't want to cut. Here's education. No, I'm a professor. I don't really want to cut that. And so, maybe, but that doesn't make me feel very happy. Basically, the issue is what to cut. A lot of this is very dear to various people. So how do you go about cutting these things? And this net interest, which is 13.8%, it was back in September 2021, only 5.2%. So this percent of our spending interest is going up because interest rates have gone up, as inflation's gone up, as the Fed has moved to not manipulating interest rates. And unfortunately, we'll talk about this when we get to Fed policy, our last Treasury Secretary, Yellen, financed a lot of our debt during her term with short-term debt, and short-term rates are much higher now. So basically the green is going up, which is making this deficit situation worse. It's just it goes up because there's more debt, and a lot of the short-term debt is rolling over when there's higher short-term rates. But that also tells you why presidents in Congress and others may want low interest rates to be able to afford this deficit situation. Let's keep moving on. I told you in the advertisement for this that we would talk about the total amount of debt and economy. And you have to, this is looking at debt as a percent of GDP. So far, we've just been talking about federal debt. So that's the debt of the US government as a percent of GDP. You can see it's been rising as a proportion of GDP. But what I'm showing you here on this graph is the total amount of debt in the United States relative to GDP, the total amount. This was the financial bubble, the housing bubble. The total amount of debt, including households, you and me, including businesses that are not banks, including the green is banks, including state and local, debt, including the federal, and then some other, actually, I guess this is state and local debt here. This was a foreign debt. But that was the financial bubble, okay? COVID, we ran up debt quite a bit, a bunch from the government, and that's just to jumpstart us out of the recession. But if you look at the total now, the total amount of debt as a percent of GDP, just think of the GDP as your ability to pay debt, as your sales of the economy. The total amount of debt as a percent of GDP is about as high as it was right before the peak of the financial bubble. I've been saying for more than a decade, I found it ironic that the Federal Reserve in the 2010s, kept interest rates so low that it allowed more and more people to borrow. And the reason why it's ironic is the financial crisis was caused by too much borrowing. So why would you want to keep interest rates extremely low for 15 years, well, until the COVID and inflation, so maybe for 12 years, which just allowed people to borrow more money. When you borrow, all you're doing is bringing future consumption today, because you eventually have to pay it off. Now, it's possible you pay it off by borrowing the same amount again, but what if all of a sudden that the ones that lend you money don't want to lend you the money anymore? So I do agree, Federal Reserves have to lower interest rates and, in a recession in order to jumpstart the economy with that good battery from monetary policy. But I do believe there's a point of time where you have to normalize interest rates. Otherwise, it causes a lot of distortions. In this particular case, a lot of debt as a percent of GDP. Now, things have changed, though, the midst of debt. Since this period of time, when we had the financial bubble, the financial debt has come down. So basically, that means banks have less debt as a percent of GDP. Banks were actually forced to fix their balance sheets. Consumers are also better off. So this is household debt as a percent of GDP, and this is a ratio of financial obligation ratio. Essentially, it's, what things do households have to pay, interest on a mortgage, interest on a credit card, and things like that as a percent of their income. So it peaked at around 18% at the financial bubble, and we're down to 14%. Part of the reason it's down 14% over this, is because debt's come down, but also initially it was because interest rates were really low. So banks are better off and consumers are better off, and these are the ones that were part of this bubble back here. But if we have the same amount of debt to GDP now as before, then something means worse off, and that's the federal government. The black line here is the federal government's debt to GDP. And you can see back in 2009, it was around 40%. Now we're right around 100%. The Congressional Budget Office projects it to go to 117% by 2034. That was before the OBBB. After the OBBB, looking at various estimates, remember, we got about $3 trillion more in debt that's coming out. That should rise to maybe 125% of GDP. So it's going up. Now, again, part of the reason why this is going up too is, our people are aging. And if people are aging, then Social Security, you can see here, is rising as a percent of our total receipts. Medicare is also rising as a percent of our total receipts. So basically we have an aging population who's retiring. So no matter what, we're heading from 100% to 117 just because we have fewer people working to pay for the people who are retired. And then, you know, the new bill, which is short-term stimulative, but it's also really adds to the deficit. So this situation is getting worse. Okay. What's the other thing that levered up over this time? Non-bank corporations. You can see that these are recessions. These lines tends to be non-bank corporations tend to borrow more right before recessions, and this is kind of the borrowing, and it's getting up higher and higher. Well, over this whole period of time, interest rates went down, so they had, you know, it was easier to borrow if interest rates are low. It really spiked here during COVID, and it's gotten better. So it's declining recently, so it's actually a little bit better level than it was back a little bit ago. Often, or sometimes, politicians will argue about what's called the debt limit. So if we look at the top graph here, this is, well, basically, you see the 70 here. Since the 1970s, Congress has lifted the total amount of debt they're authorized to have 70 times. Most of the times they lift the debt limit. You know, if there's a deficit, which normally there is a deficit, that means you need to have more debt each year. And most of the time, you know, the Congress has lifted that limit without a bunch of arguing. Sometimes, and mostly in the last 10, 15 years, as the amount of debt to GDP has been soaring, there's been a lot of arguments. It was a very close call in July when the last debt limit was raised, okay? The limit was $36.10400 trillion. In July, they raised it after they got to $37.10397 trillion. And this was part of the negotiation and discussions with the OBBB. Now, why do we have this debt limit? Well, since 1917, there's been a debate on how much we spend and how much we collect in taxes. And if you think about it, if every once in a while the government has to come back and say, our debt's gone up, and they're forced to actually vote on raising the limit so they can keep the deficit going, it forces them basically to keep a lookout on the budget, to be responsible. And if you're responsible, that should lower your cost of debt overall. And most of the debt in the world, or at least in the United States, is based on, to some extent, the risk-free rate, which is the rate on government debt. So if the government's responsible, the risk-free rate should be lower. If the risk-free rate is lower, your credit card, your mortgage debt, your car loan, that interest rate's lower. And if interest rates on that's lower, by the way, then you got moderate interest rates that can help allow people to borrow, hopefully responsibility to spend, and that spending helps grow the economy. So it's a good thing, I think, to keep track of this over time. But recently, over this last 10 years, it's been kind of close calls a few times whether the government was going to raise the debt limit. In elections and every few years, I hear that people say, hey, if you have more debt, you can have bigger deficits. That kind of makes opposite sense. I mean, if you have more debt and you have more interest payments, how can you have a bigger deficit, more spending relative to your taxes? It turns out that argument is sort of true. It's sort of true. So what I've done here is I give you an example. Let's say the amount of debt to GDP is above 100%. So let's say the total amount of debt in the economy, let's say, just as hypothetical, is 1,100 and GDP is 1,000. And so the debt to GDP is 110%. So keep following me. Let's say GDP grows 5% over the next year. So 1,000 goes to 1,050. And the government spending 4% more than they're collecting in tax revenues as a percent of GDP. So the deficit over that year is 42. So your debt goes from 1,100 to 1,042. Well, turns out your ratio of your total amount of debt to GDP, 1142 divided by 1050, goes to 108.76, which is lower than the start. So if you actually have more debt, this says, hey, I can afford the deficit better because my debt is a proportion of GDP, and GDP is the sales that helps you pay the debt. It actually goes down. Now let's look at if your debt starts at less than 100%. Now, if you're at a less than 100% ratio, let's say GDP again is at 1,000 and it goes to 1,050, so GDP grows 5%. And your deficit is 4%. So that's 42. So let's say your debt starts at 800 of 1,000 or 80%, and it goes to 842. 842 of 1,050 is, oh my gosh, the debt GDP goes up. If using the exact same example is up on the top, so if debt to GDP is less than 100%, you really can't afford 4% deficit because the 4% deficit makes your debt to GDP go up. But if your debt to GDP starts at greater than 100%, then if I have that same deficit to GDP with the same growth to GDP as I had down here, my total amount of debt to GDP goes down. Okay, I understand the argument. But the problem is it also matters just how fast GDP is growing. It matters also how the market's going to respond to these bigger deficits, whether your interest costs are going up. Just think about that. All right, so one of the big things is, let's look at the second point on here. If you have 4% GDP growth and 4% deficit, this drop here, so if you only have 4% GDP growth and you got the same 4% deficit as you have up here, with a lower GDP growth, this 110 goes to 109.77. That's lower GDP growth. If you have higher GDP growth, it drops more. So one of the things that really matters on this debt to GDP is how fast is GDP growth going. So you can afford bigger deficits if your GDP is growing faster, because GDP is literally the sales to be able to pay the deficit, right? So how do you make GDP grow faster? Maybe government policies. Iffy success in the past, but it's also pretty hard to track that. Maybe AI will make GDP grow faster, but well, if it makes unemployment skyrocket, which was the subject of the first webinar in this series, if you want to learn about that, that would actually make the deficit worse because there's going to be more unemployment insurance. Maybe eliminating Fed independence and lowering interest rates, which will make inflation go up, which inflates GDP, will get you out of that situation. But of course, high inflation is really not good for the economy. The consumers really won't be happy, probably cause a recession because Fed, watches inflation. So we don't really have too many good solutions to making that GDP go faster. So when will this problem kind of be fixed? Okay, so this is my last slide on fiscal policy. So when will the problem be fixed? Well, unfortunately, after thinking about this for 25 years now, I started arguing about these policies 25 years ago and worried about our situation today. It was very obvious what our situation was going to be today 25 years ago when we first were lowering taxes. We knew the demographics, people will be aging, you're going to have more Social Security and Medicare costs, healthcare was rising really quickly. So back then, 25 years ago, we had a government surplus, and we cut taxes. Okay. Now, at the time, I was managing money and pretty high tax break, and I said, you know what? I want us to be responsible. I didn't really like that. And by the way, I do not have political affiliations. I'm a neutral person. But I said, hey, this is going to get really worse over time just because we knew what was happening with demographics. Okay. Unfortunately, my forecast, when will this be fixed, when it must be fixed, not before, seems to be happening. And when it will be forced to be fixed is when investors are no longer willing to lend to the US because we have too much debt. Okay. We can already see that maybe starting to happen now. Now, if you look at the 10-year interest rate, there's three things that drive the 10-year interest rate. There's inflation, there's growth, and there's this thing called the term premium. The term premium, you can see different estimates of term premium are all rising. That's what this graph is actually showing you on the top, okay? The term premium rises if people are maybe a little bit more worried about U.S. government ability to pay debt, if they're worried about inflation rising in the future, whatever it is. But the term premium seems to be moving up. And it may be moving up, if you look here, the United States, relative to most parts of the world, has more debt to GDP, and it's getting worse. So once that gets bad enough and the term premium rises enough where interest rates go up and makes the government deficit situation worse, or if interest rates don't go down, we'll be forced to reckon with it. What exact date may that happen? Well, when Social Security runs out. This is a Social Security countdown clock that I pulled up on the slides a couple days ago. So 8 years, 2 months, 21 days, 9 hours, 45 minutes, and 37 seconds. That's when Social Security becomes insolvent. Now, I think it's actually going to be a couple of years before that. It's going to be the election before that the politicians have to come together. And Social Security is something that the Democrats generally, remember, I'm a neutral here in both parties. I like to see things both ways. So I'm kind of one of the ones that are neutral on all these policies. I have a feeling at that point of time, just before Social Security runs out, the Democrats really think Social Security is sacred. We don't want to do anything with it. So they're not going to want to cut. And the Republicans, these are averages. I realize they're going to be people who are completely opposite of what I'm about to say. So I apologize to those people. But on average, older people tend to vote Republican and younger people tend to vote Democratic. That's on average. There's obviously lots of exceptions. So the Republicans at that time, which have really wanted lower taxes, they're probably going to raise taxes in order to make their constituents happy, because if they cut the benefits, which the Democrats probably don't want to do, they're going to lose a lot of votes. If older people in general continue voting Republican. So the solution to this probably is higher taxes are coming at some point in time. Right, so that's fiscal policy. That was 11 slides. I have like 20 on monetary policy, and we only have about 20 minutes or a little bit more. So let me walk you through monetary policy, and then I'll take some questions just a little after the hour. Okay. All right. So first of all, my first point on monetary policy is I think people put too much faith in the Fed. So my career started in the 1990s. I've been in investments for over 30 years. And I remember when Greenspan, Federal Reserve Chairman, said, and this is in 1999, his infamous irrational exuberance, he actually said the market was not at a peak of the internet bubble. I believe this on Squawk Box CNBC happened in 1999. I looked this up on Sunday. So that was Bernanke. And then we got, that was Greenspan. Then we got Bernanke. Right after Greenspan is the Federal Reserve Chairman. Right before the housing bubble peaked, he said, when people asked him on CNBC if housing's a bubble, he said, no, it's supported by the strength of the economy. Well, Bernanke, you got that one wrong. Greenspan, you got this internet bubble wrong. then we had Yellen. I already told you that we kept interest rates, in my opinion, which caused a lot of distortion, interest rates too low for too long, which allowed the government really to go on a big borrowing binge. It actually allowed non-bank corporates to lever up as well. A lot of that was also to buy back shares. Yellen, when she finished her term as chairwoman of the Federal Reserve, she went to work in the Treasury as the secretary, the Treasury secretary. Unfortunately, during COVID, when interest rates were really low, she basically financed a lot of the government spending, the big deficits with short-term rates that are now resetting at as that debt comes due at higher rates. And when I looked at her, recording, she said, "Well, debt's stabilized relative to the size of the economy. This is okay." Of course, debt continued to rise as a percent of the economy. And then what did Powell say? Well, Powell said that inflation was transitory back when it was spiking. So just for the record, when that happened, I wrote, so I have writing on this, that I was worried about Powell missing the inflation. Okay, so what does the Fed do? So my first thing is maybe don't put too much faith in them. So how does the Fed control interest rates? One is they influence it by talking. People trust them, okay? Another way they do it is changing the amount of reserves banks have to hold. Well, that's actually zero right now. Another one they do through open market operations and changing the discount rate. So basically, the Fed funds rate is controlled by this money supply, buying and selling bonds. And then there's also the discount rate. The discount rate has been coming down, the bottom chart. Money supply is the blue line on the top chart, and it's inverted. So money supply is accelerating, and 2-year interest rates have been coming down. So money supply growth accelerating, Fed funds rate coming down. That means the Fed is being somewhat stimulative. All right. Does the Fed use the right indicators to set monetary policy? Well, the Fed targets employment and inflation. They like low unemployment rate and they like 2% inflation. Turns out, I think one of the mistakes when Powell said he's data dependent on setting these interest rates is he's dependent upon the wrong data. The Conference Board, look at the top right, has various indicators that lead the economy. The middle in gray are coincident to the economy, and the red on the bottom lag the economy. If you're setting monetary policy trying to influence the future, should you be really setting monetary policy based on 2 lagging indicators, prices, one kind of coincident indicator, payroll employment? I have a feeling they use the wrong data, and they say they're data dependent. I already told you that Powell kind of infamously said inflation's transitory. Remember, one of the things that Fed does to influence people's interest rates and attitudes towards spending is just talking about the economy. This was his press release in March 17, 2021. He said, "I would note that the transitory rise in inflation above 2% seems likely to occur this year would not meet the standard of 2% inflation because it's just transitory. It's related to some supply chain problems." Did the market believe them at the time? So on the bottom right chart, the black line is long-term interest rates, 10-year. They were actually pretty well contained. When the red line, inflation was spiking. The blue line is the market's expectations of inflation. It was going up, or nowhere near what inflation was. So that Powell was trying to influence inflation by saying it's transitory. Was he successful? Yes, somewhat, because he kept interest rates down and he kept expectations for inflation down. So he was pretty successful with the Fed speak, but wasn't really successful with what happened because inflation really did spike, okay? Powell at that time, when he made that comment, he said, "You know what? I'm okay with a little higher inflation." I don't care about inflation being transitory, because if you look at top left graph, the actual core inflation rate relative to 2% inflation growing over time, we're running a little bit below. He said, that's okay, we can target average inflation. And then we can allow it to run a little high for a little bit. Well, it ran a little high for more than a little bit. And extending this graph from 2005, inflation's up 60%, where 2% would have it up about, a little bit lower than 50%. So inflation's been running hot for a while. It's part of the reason why they're arguing right now about lowering interest rates, because inflation also spiked up here recently with the new tariffs. Is the Fed speak working? The blue line on the bottom left graph is expectations for inflation based on a Michigan survey. Expectations for inflation over the next year. And I have the blue line leading the actual inflation, the red line, by 4 months. Well, people are expecting a little over 3% inflation over the next year. We'll probably get it based on historical standards, and the inflation rate, the red line, is actually starting to go up a little bit. Now, of course, part of that going up is tariffs. Now, how do we actually resolve this inflation, get the inflation back to this 2% trend line? One thing you could do is just cause a recession. So the graph on the top right looks at the change in unemployment rate, and it's inverted, and the change in inflation. So when the unemployment rate, kind of the pink, is going down, that means the unemployment rate is rising because it's inverted. And you can see what happens to inflation rate, the growth of inflation, which is the red line. It goes down. Well, we had some good news for the Fed on this one, but kind of good news, bad news, because the unemployment rate today went from 4.3% to 4.4%. So if the unemployment rate is going up, well, maybe the inflation rate will be coming down. Unfortunately, remember, the Fed has kind of a dual mandate, low unemployment rate and 2% inflation. So that presents a little bit of a quandary. Now, which one's more important? Where does the Fed's funds rate, where should it actually be? So the bottom left chart, I'm looking at the Fed funds rate, the rate that banks borrow from each other, with very short-term interest rates that ultimately sets long-term interest rates, because banks, if their cost of funding short-term is low, then they can afford to lend long-term also at low rates. I'm looking at the Fed funds rate in the blue, the shaded, relative to inflation, which is the red line. And this is the inflation rate each year. Notice when inflation kind of spikes up, red goes up, normally the Fed funds rate kind of rises, and it's a pretty big gap versus the inflation rate. And this is the 1980s, a couple times. We had something in the 1990s. I'm kind of highlighting in the purple area every time this Fed funds rate went up, which is, the Federal Reserve's main policy tool. This is what happened recently on the right. So inflation spiked, but the Fed's run rate was basically kept at zero. And it took a while before the Fed's funds rate became higher than inflation, which is the red, before the blue became higher than the red. And the amount that the blue became higher than the red is less than normal, less than normal, less than normal, less than normal, less than normal. No wonder inflation has been running hotter than target 2% for longer than normal. Possible that we didn't raise the Fed funds rate enough, but we did raise it rapidly. Now, what does the market think is going to happen in the future? This is what's called the Fed funds future. What the market's expecting the Fed funds rate to do in the future. Currently, the Fed's funds rate's, right in between this range. And the market expects the Federal Reserve to lower it to, by 2027, about 0.75%. And they've changed their attitude over this year. At the start of this year, if you moved out there, they expected higher initially, about the same terminal. Okay. And that was in July. In April, when the trade war was really running hot, and we were worried about a recession, they thought the ending rate would even be lower. Clearly, the market must think inflation solved, because if they didn't think inflation solved, they wouldn't probably be thinking the Fed's going to be lowering the Fed's funds rates more. Why is this important? I told you earlier, the rate that banks borrow from each other influences long-term rates. That's what's in the top left graph. Generally, as the black line's going down, the Fed funds rate goes down, the long-term interest rates go down. Why is that good for the economy? And I said it in the last webinar, so you can go look at that recording, is if interest rates go down, let's look at the top right graph. If interest rates are falling, then this black line tends to, and it's inverted, the black line tends to go up with about an 18-month lag. So what is the black line? That's basically manufacturing activity in the United States. So if manufacturing activity tends to be correlated with GDP, if the black line is going to be going up because interest rates have basically stopped rising and maybe even start to go down a little bit, the economy is going to get better. Now the black line on the top, I uninverted on the bottom and it becomes a blue line. Sorry about that. But I do like to have all my graphs where the driver is on the left in blue and what is being driven by that factor is on the right in black. So at the moment, the manufacturing activity is very low, but the stock market's very high. So what I can say from looking at these graphs, the market, since this is a really difference, normally they run pretty close together, the market's thinking the economy is going to accelerate from this lower interest rates influenced by lower Fed funds rate. So it's kind of important to what's going to happen in the future. The yield curve, okay? The yield curve basically looks at the difference between interest rates on the long end and the short-term rate. The purple line is the difference right now, okay? And the difference between short-term rates and long-term rates is basically zero. Short-term is controlled by the Fed. Market's thinking the purple is going to drop over time, but the current is high because that's controlled by the Fed and the current policy. Now, when the purple goes down and if the 10 stays high, that means the yield curve is upward sloping. You see back in 2021, it was upward sloping. Long-term interest rates, 10, 30-year, were greater than the short-term interest rates, which were kept at zero to get us out of recession. The 10 minus the short-term rate, or the 10 minus the 2-year, the 2 years right here, are plotted in these two graphs on the right. Notice when the 10 and the 2-year basically become the same amount, where it becomes flat. That happens before recession. It gets flat before recession, flat before recession, flat before recession, flat. Where's the recession? And then you can also look at the 10 versus 3 months, same thing. It turns out, though, if you look at this really closely, that, well, the 10-year, if it's less than the 2-year and the 3-month, a recession happens. The recession doesn't happen until it uninverts, right? The recession happened when the 10-year became greater than the 3 months. And what's happening now? The yield curve's uninverting. Does that mean a recession's already happened, or does that mean a recession is imminent, about to happen? Leave that up to you to think about. Now, I told you I would talk a little bit about Powell and Powell's policies. And there's this thing called quantitative easing. And there's something called yield control. Remember, right now, net interest expense as a percent of the outlays is 14%, up from 5% a few years ago. One of the things that I've heard talking about is, why don't we use quantitative easing where the Fed goes up and buys up bonds, which pushes down interest rates? Why don't we use it to lower the long-term interest rates? That would be yield curve control. Kind of a variation of quantitative easing where the Fed's just out there buying up all bonds. But they could be out there just buying up long-term bonds. Now, when they buy bonds from you, like say you own a treasury bond, they buy a bond from you, they give you cash. When they give you cash, that cash can be result to buy, you can use it to buy stuff. If you look here, this cash in the system, M2, when it spiked during COVID, when the Fed went out there and bought up a whole bunch of bonds, what happened a little bit later? Really high inflation. So one of the outcomes of quantitative easing can be inflation. There's an equation for this. It's the amount of money in the system times the velocity of money equals price or inflation times the amount of quantity. This is an equal sign. You can look up prices of stuff. You can look up the quantity of stuff. That's real GDP. You can look up, kind of the amount of money in the system, and they actually solve for V. So this isn't even an approximation. If you increase the money supply by 25%, it has to go someplace. It could go in banks' vault savings. It can go to buy stuff, quantity. But if there's no quantity out there to buy because you are in COVID and you have some supply chain problems, then it's going to go to prices. Powell said when they are pumping up money supply by 25%, he said, you know what, Milton Friedman, let's talk about Milton Friedman. He said, inflation is always and everywhere a monetary policy, having too much M. What did Powell say? We've had big growth in monetary aggregates at various times without inflation. So I guess it's something we have to unlearn. I would argue that he went back to school in 2021-22 because this monetary growth resulted in huge inflation at that time. And that's because we didn't have enough quantity. How did that impact the stock market? How did that impact the economy? Well, again, it impacted inflation, the P, but this is the Federal Reserve securities going up and down in blue on the top left graph. What happened to the PMI, which we know is highly correlated to stock market? It went up, and that's the Q. Now, what happened to the V, the velocity? Well, not all of it ended up in P and Q. Some may have ended up in savings or paying down debts. So if we look at the Federal Reserve securities here, the growth in it, and look at the one-year change in S&P 500, they're correlated. This balance sheet got to nearly $9 trillion. Right now it's $6 trillion. The Fed has advertised on December 1, we're going to stop reducing this. Has very important implications to policy going forward. Every time the Fed is actually put on the accelerator on money supply relative to GDP, so if M's going up versus P and Q, which is nominal GDP, we haven't had a recession. So I'll let you, and I'll send these slides later with the recording, you can analyze it a little bit closer. But right now, the blue line, the M, is growing a little bit more than the P and Q. And when they have done that in the past, the black line is the PMI, which I said is correlated to stock market, correlated with GDP. When they've done it in the past, where they really accelerated the amount of money relative to GDP to P and Q, we haven't had a recession. But when we didn't accelerate it, all these shaded areas are recessions. So this would indicate they're trying to avoid a recession here. I'm going to just take a couple more minutes with a couple more slides, and then I'll take Q&A, okay? So what is the difference between fiscal and monetary policy? Well, they both have big meaning to your lives, to interest rates, basically to everybody's spending, okay? Fiscal policy is dependent upon government policies. It has a direct influence because if they lower the taxes, that can increase your spending. If they increase spending, well, it increases spending. It can be immediate stabilizers, lower taxes in recession, or it can be delayed. Lots of politics involved, lots of decisions. Monetary policy, on the other hand, got to do a mandate. employment and price stability. It's very indirect instead of direct. They can act quickly. They have models involved and few decisions. Is there rules in fiscal policy? Not really. It's possible very much influenced by politicians that want to get reelected or got elected based on certain policies. Monetary, yes, they do have rules to make decisions. They have a lot of very smart people. They're supposed to make it for the best of the economy long term, not just for their next election. The current rule the Fed has is called a balance rule that actually looks at inflation and unemployment. And it would say, and I'm not going to go through all this, but interest rates are about 1% too high. They should be coming down. I actually tell you the truth, not 1% too high. They should be coming down to 3.5%, just a little bit lower than they are right now. In consideration of inflation and unemployment, which is, well, at the time I did the slide, which was before today, was exactly at what's called NAIRU, the natural rate of unemployment. The last thing I want to talk about is, should the Federal Reserve think about the stock market? A lot of people are saying AI, maybe it's a bubble, when setting policies. Various people have talked about this over time, but it turns out the Fed actually has a third mandate. I mean, they have the inflation and employment mandate, but they have a third mandate in moderate long-term interest rates. And when you say moderate long-term interest rates, that's to encourage investment and spending at a moderate rate, not too high, not too low. So if you think that is a policy, it's often overlooked that the Fed should have, well, what's happening with the stock market matters. Because if the stock market is doing really well and there's a lot of wealth, people will be spending a lot, and that can be inflationary. And the Fed has kind of ignored this third mandate a little bit, at least as far as the stock market. Now, other people will argue that no, they shouldn't target the stock market. And one of the arguments is, are they really very good at figuring out bubbles? I would argue that Greenspan and Bernanke weren't. And they also say, hey, the Fed can always react to recessions if it's caused by some kind of a bubble, as long as it's not in the financial system. Well, those are my remarks today. I do have one question that was written in ahead of time. I'd be happy to answer some questions. We have about 6 minutes left, and I look forward to that discussion. Okay, I have, I'm looking at the questions in the chat right now. Let me just read them for a second. All right, so we have a question that says, relative to our growing debt burden, what would you think about letting inflation run higher to inflate away our debt? Some years ago, I had a colleague at another university, or a friend at another university, who made the comment that the US will run inflation hot for some time. Because if inflation runs hot, GDP goes up, because GDP is a function of units and inflation. And if GDP is higher, you're going to get more tax revenues to be able to pay for that debt. So that's exactly what this question's asking. The problem with that is, when inflation runs really high, normally wages don't keep up with it. And that makes your population very unhappy. It is a way to solve this problem, assuming the Federal Reserve will not raise interest rates to combat that inflation. And if they do that, and they raise it enough, that'll cause a recession, which means people will lose jobs. So you're going to be losing jobs, so people have less money to spend right when the prices of things are higher. So it sounds kind of good in theory until you start thinking about the second and third impacts of that. So it's a lot more tricky than just saying, hey, let inflation run higher. Someone asked about how is unemployment measured. I think the question is really about is it measured correctly? okay? Let's just look at every week we get the, I'm kind of going to say sort of yes, that there's some problems, okay? One that I've written on in the past is every week, well, except when the government was shut down, we got an aggregate data on number of new unemployment claims each week. It turns out a lot of people in this economy are working in what's called the gig economy. You know, right 2 minutes before the session started, someone pulled up in a car to deliver a package to me. Are those people correctly considered? If you're working multiple jobs and some are gigs just delivering packages or doing consulting on the side, is that being captured as unemployed? Well, if you have 3 jobs, you're unemployed in 1, so you're underemployed, and because you really like 3 jobs, you're counted as employed. So there is some problems with that, okay? I have a question as, do I believe there'll be a recession in 2026? Okay, we may already had one, first of all, I'm gonna say. Remember I said the yield curve inverted a few years ago? So let's go back to this. So the yield curve inverted. Normally you would have a recession. We had AI take off right after yield curve inverted. So if you look at the S&P 500 earnings, they're up, but it's basically been a small set of stocks. If you look at small companies, medium-sized companies, and large companies that weren't part of the one in the AI trade, their earnings went down. So we had a recession. So I'm wondering if we've already had one and it just wasn't overall recession. Now, in my last video, I said, now, why didn't we get a recession here? Part of the reason why we didn't get an overall GDP recession is because we had a lot of immigrants. We had an influx of immigrants that spent, right? Second big thing that happened when that yield curve inverted is we had a huge government spending. It's 17% of spending. And if that goes up a lot, then GDP could come down in the private sector and maybe government spending makes up for it. And the third thing is, after we had all this earnings growth coming out of COVID, we actually had a lot of investment spending. And investment spending, if you remember earlier on my slide, is quite volatile. So outside of the government, immigrations, and maybe that investment spending, it's possible we had one. Now let's talk about 2026. I tend to try not to give forecasts and stuff like that in here, just because you may have different risk preferences and things that I have. What I will say on that is the probability of a recession is significantly higher than the stock market says. The stock market is very high right now, while the PMI is very low, and the stock market is saying no recession. So I would say they're not giving it enough credibility. I'd love to stay and talk more, but I promised you an hour and 10 minutes, and my hour and 10 minutes is up. And I wish you a wonderful day, and thank you very much for your time.